The subprime crisis was the beginning of the financial crisis. It showed the world how poorly designed the financial system is and how it rewards maximum risk. There is no consequence for the chosen few who are deemed too big to fail. Unfortunately, we quickly realized the problem of subprime was not contained to subprime. It was much, much worse. Today, we see another, different kind of subprime crisis evolving. You came here for the truth, so let me unveil that for you. Today, we are going to look at an issue that is not being discussed in the mainstream. It's barely being discussed in the alternative, and that's why you've come here. Let's get into it right away. Smaller subprime auto lenders are starting to fold. This information is as of April 2018. We need to understand what's going on with subprime, because if we learned any lessons from the previous subprime crisis, we will know that it isn't contained there. And the reason that is simply is because of securitization. Securitization is basically taking all this debt, usually the worst kind of debt, packaging it all up and selling it off to investors. You need to understand that your loans that you have taken out from the bank have been packaged up and sold off. You might be with Bank of America, as they use in this case here. You think that your loan is with Bank of America, but really it has been packaged and sold off. And the average person doesn't understand that. The average, investor doesn't even know about that. They don't care about that. But that's very, very critical, because it is all being packaged as one, and subprime starts to lead and basically spill over into prime. And that's how we had this issue previously, where they said, oh no, don't worry about it, there's no problem. Just a little few people who can't pay, it's being taken care of. Then they realize, oh, wait a minute, there's a lot of fraud going on. Oh, wait a minute, it's not just subprime. And then we saw it unfold. The entire world was affected, and that sort of trigger event began with subprime. Today, it's a little different. Growing numbers of small subprime auto lenders are closing or shutting down after loan losses and slim margins spur banks and private equity owners to cut off funding. There's a couple examples here. I'll just cover it quickly. This particular company filed for bankruptcy late last month after lenders, including Bank of America, said, check this out, they misreported losses from soured loans. Where have you heard that before? Home Capital, same issue. We heard about this going on even more recently than that. The whole ninja loans scenario. This was a big issue. The same thing is going on today. It doesn't happen all the time with the, big banks and things. You tend to get it with the alternative mortgage lenders because people are going there. They don't have the best of credit. They don't have a good situation financially. So they go there, they talk to them, and they'll say, look, I think you're able to pay. We'll cut you a deal. Don't worry about it. Everything's going to be fine. Then they have to basically default on these loans. They have to go bankrupt. That's okay if it happens to 1 or 2 or 5 or 10, but suddenly it gets worse and worse. And all of this is at a time when interest rates are not continuously declining. That was working years ago. As interest rates were getting lower and lower, people were able to withstand this high debt. But not anymore. Because it's not at zero anymore, suddenly it makes a big difference. All right, the next one here, subprime auto lender filed to force the company into bankruptcy last week after a separate group of investors accused the company of, guess what? Fraud. That's right. This company here, specializing in deep subprime borrowers, finished winding down last month after seeing its profit margins shrink. This is what is going on today. I'm not going to get into the whole article for you, but I just want to let you know that the same issues we were seeing before are happening again. It doesn't matter where it's coming from, and I'll show you a chart at the end. It doesn't matter where it's coming from. All that matters is that we have a trigger event. That's going to unleash hell upon the system. Moving on. Auto loan delinquencies by percentage, you will see that while, okay, it's not 50%, it's not 100%, but it's getting bigger. And this has increased over the years. Going in here, basically since they started to increase interest rates, or they're talking about increasing interest rates, we had this big issue. So it peaked out, of course, around the financial crisis. People couldn't afford things, and you saw that deleveraging occur. This deleveraging did not occur in places like Canada, for example, where everything is just fine and it's just rainbows and sunshine and all sorts of business. But essentially what we've seen here is a deleveraging that occurred after the financial crisis. It goes with, credit cards, goes with everything else. But ultimately what you're seeing here is that more, as time goes on, there are more auto loan delinquencies. Okay, moving on. Car makers that used 0% financing offers to juice sales at the height of the American auto boom are starting to abandon them as rising interest rates lift their own borrowing cost. Exactly what I'm talking about. This is all interconnected, and interest rates are the primary factor. People want to know, when is this all going down? You keep talking about a collapse, but when? When and when? Interest rates are the primary indicator. There are literally thousands. I've covered them here on the channel, but what you need to focus on are interest rates. Around the world, they have started to notch up interest rates in many areas, and if they do so, if they continue to do that, we're going to be left with a big problem, because there's so many things that are interconnected with interest rates. Look at the LIBOR. Literally, there's so much interconnected with LIBOR. Imagine how important the US dollar is to the economies around the world, to the interest, to the financial systems around the world, all using US dollars in some way. If something happens to the US dollar, the whole world is affected. Well, of course, the same thing happens with LIBOR. The same thing happens with the Federal Reserve's interest rate, the Fed funds rate, and other things as well. Okay? The average interest rate on consumers' new car loans climbed to 5.7% in March, the highest since, guess what, 2009, up from 5% a year ago. 0% offers fell to 7.4% of auto loans last month, down from more than 11% prior year, and the lowest share in more than 2 years. If people are not able to buy their cars using 0% interest, if it's, for example, nobody wants to be the first to go from 0 to 0.9 or from 0.9 to 1.9, but you're going to see 0 no longer the norm. That's how desperate they were to push this stuff. Giving it away at 0% interest. I can't believe it, but they're doing it. And that's how you boost sales. That's how you're able to get people borrowing more than they can really afford, because you give it to them at 0 interest. Credit cards, you get people on there, you tell them that they'll be able to pay it off, but of course, they never will. They carry a balance, and those balances, the interest rates on credit cards, they're excessively high. But people have this belief that, don't worry, I couldn't pay it this month, I'll pay it next month. So I'll just pay the minimum now, I'll pay the rest next month, or maybe 2 months. Or is it 3 or 4 or 5? Well, ultimately it just gets worse. It has a snowball effect. That's what debt does. And ultimately people are going to see the fact that, okay, maybe I can afford 0.9%, but then the next time they go to lease their car or finance their car, whatever this is financing in this case, they can't afford it. So we have a big problem on our hands. Has anybody seen this in the mainstream media being an issue, a topic that people are talking about? Of course not. And I don't believe that they are ignorant to it. I believe that they are willfully ignoring it. Past peak lending, finance companies lending to less creditworthy borrowers, has been declining since 2016. Auto finance company lending to borrowers with less than 660 credit scores. You'll see that coming off from the peak, but you saw what happened, of course, leading up to this moment. It is consistent. I mean, you could see that clearly going from 2016 into 2017. we definitely see what's going on. We'll see if it's a continued trend. I wanted to bring this in here. This was the looking at the Fed chart, basically the St. Louis Fed. They'll have some excellent charts from information around the world. In fact, I'm sure you've seen it before. Motor vehicle loans owned and securitized. Okay, there are a few things that you always need to look at, and that's the credit card debt, the student debt, and in this case, motor vehicle loans owned and, importantly, securitized. And a lot of people simply forget that. They think that auto loans are held between you and the person that you borrowed that money from, or borrow that car from, or borrowed that house from, whatever you want to call it. The banks, the institutions, financial industries, whatever, different companies that are involved in all of this, they take your debt and they sell it off. And this has been so profitable to them. So that's what a lot of individuals don't ever see, because you make the payments to the same company, you don't know the difference, but it is being sold off. Okay, so this right here has shown us that we're going here from the financial crisis into new heights. Deleverage, barely, not enough, and so it just rises yet again. Same with credit cards, same with student loans, same with every other kind of debt. Don't go anywhere. Make sure you click on part 2 of this video. It's in the description. I'm going to get into why debt is so dangerous right now at this time.